The people figure out systematically that things are inflating because they're paying the price of those things. Whereas investors or people like me already front run them. That's the whole point. You got to get long inflation before the people at large realize it. And that by the time some government guy, central planning gal, by the time they tell us that inflation's here, the investment opportunity to have been long commodities or Bitcoin for that matter is way in the rearview mirror. I don't think that the gold price and the Bitcoin price in particular are validations that great central market plannings are working. I think that they're telling you it's the beginning of the end of an establishment and a regime like the Federal Reserve.
Welcome back to The Breakdown with me, NLW. It's a daily podcast on macro, Bitcoin, and the big picture power shifts remaking our world. The Breakdown is sponsored by Crypto.com, Bitstamp, and Nexo.io, and produced and distributed by CoinDesk. What's going on, guys? It is Wednesday, August 5th, and today I am so excited to bring you an interview with the mucker himself, Hedgeye CEO Keith McCullough. We are going to get into everything from the devalued dollar to Bitcoin and beyond, so stick around for that. First up, however, the brief. First up on the brief today, Robinhood doubles its second quarter trading revenue. Robinhood has obviously been throughout the year a huge force in the markets, at least from a narrative perspective. They have commanded the attention of media, but the question is, are they really growing in step with that? Well, their revenue doubled between quarter one and quarter two, or at least nearly doubled from 91 million in quarter one to 180 million in quarter two. Of that, 111 million or 62% came from options. Options have obviously been at the center of some of the strategies deployed by folks like the Wall Street Bets community to try to drive up prices in the short term in order to benefit. Importantly, this growth is not just limited to Robinhood when it comes to telling the story of retail. Other brokerages are going up as well. TD Ameritrade saw its revenue grow from 220 million to 340 million between Q1 and Q2. E-Trade went from 85 million to 120 million. So what does this all mean? Well, one, the trend lines are clear. There is growth in retail trading. Impossible to deny it just looking at these numbers. Second, the numbers overall are still pretty small when it comes to trying to understand this as a market force, which brings us to number 3. What matters more is that there is a clear trend line and serious growth and enough emphasis to actually potentially move certain stocks. But all of this really matters for contributing to the narrative and the narrative power that retail traders have. When both mainstream media is amplifying the narrative and high-frequency traders are amplifying the actual force in the market, which if you want to understand more about that, go back and check out my interview with Tony Greer, you have a force to be reckoned with. Next up on the brief, Square's Bitcoin revenue surges. In Q2 of this year, Square generated 875 million in Bitcoin revenue and 17 million in Bitcoin gross profit. That's 600% growth in revenue and 711% growth in profit year over year. It's also huge growth from quarter one, which saw 306.1 million in revenue and 6.7 million in profit. So why does this matter? Well, one, it's very hard to ignore this expression of interest in this Bitcoin space, right? Going from 306.1 million to 875 million is nothing to slouch at, nothing to scoff at, given that it was just a single quarter. What's more, this reaffirms the importance of Square as a central and critical channel for onboarding new people into the Bitcoin space. 875 million in Bitcoin revenue in a single quarter is a serious number. Last up on the brief today, the ADP private payrolls report. What happened? Well, ADP private payrolls is one of the two big payrolls reports that comes out monthly. The other being the NFP report, the non-farm payroll report that's from the Bureau of Labor Statistics. The ADP report is released by Automatic Data Processing, which is a human resources and management software company, but these are the two big ones. June had seen a 2.369 million jump in private payrolls, and people were expecting another solid, although slightly slower month. The consensus was expecting around 1.2 million new jobs. The actual number was only 167,000, so this is obviously a huge amount lower, something like 10 to 15% of what people expected. all of these gains that did happen were in very small or very large businesses. In medium businesses between 50 and 499 employees, there actually were a loss of 25,000 jobs. What's more, in terms of goods producing jobs, there were only 1,000 gained. So service jobs were up 166,000, but good producing jobs, manufacturing jobs were only up 1,000. And within that, construction jobs were actually down 8,000 jobs. Why does this matter? Well, again, everything is about expectations. And the expectation was to see solid growth month to month of 1.2 million new jobs. This really puts a pin in the point that the coronavirus return and resurgence in different parts of the country has stopped the growth that we were seeing and the recovery that we were seeing. This is obviously something that should be at the top of mind for anyone who's trying to figure out where we go from here. So I think it's a really important bit of data. Now, we will see what the non-farm payroll report says on Friday. Maybe it tells a different story. It's not uncommon for these two reports to tell a different story, but this one bit of data is not looking good. With that, let's get into our main conversation with Keith McCullough. Keith McCullough is the CEO of Hedgeye, which describes itself as a no-excuses provider of real-time investment research and a premier online financial media company. He has previously been a hedge fund manager at the Carlyle Blue Wave Partners hedge fund, Magnetar Capital, Falconhenge Partners, and Dawson Herman Capital Management. Most of you who know Keith know him from Hedgeye, and I think that frankly, along with things like Real Vision, these guys are completely reinventing financial media. They're speaking to a different audience, and they're speaking frankly about what's actually happening in a way that you're just not going to get elsewhere. In this conversation, we talk about Hedgeye's full cycle investing model. We talk about where things were going into COVID and why we're moving into a stagflation period. We talk about inflation versus deflation, the role of narrative, the role of the Fed, what it means that dollars are being devalued. We talk about Bitcoin and commodities. It is an awesome conversation. And like all of our conversations, it's edited only very lightly, so it's as real as it was when we were having it. I hope you enjoy this. I know you're going to. So let's dive in. All right, Keith, thanks so much for joining the breakdown.
Hey, thanks for having me. I appreciate it.
So I'm really looking forward to this conversation. And just briefly, I want to, for folks who aren't necessarily as familiar with the Hedgeye process, to define a couple terms, because I think that we might come back to them throughout the conversation. So can we kick off by having you explain just a little bit about what's the idea of one, full cycle investing, what's the GIP growth inflation policy model, and what are the quads?
For sure. They're all these things are part of the same thing. So if you just think quite simply of where are you on the sine curve of a cycle. So again, you're either accelerating up the backside of the sine curve, or you're decelerating from the peak of the cycle, for example, in growth or GDP growth, and you have a decelerating component to the cycle. So when you have both, it's really a two-factor model. So Nathaniel, when you look at it, you have GDP growth and inflation. So you got those two factors. You measure and map them on the sine curve. There's data points that are released daily. We use modern technology, predictive tracking algorithms, et cetera, and code to track that. So it's not an opinion on what the economy is doing. It's actually just what the economy is actually doing real time to the day. And then we strap that into basically a 2x2 model that gives you four different economic quadrants. So again, and they're just a combination of those two factors. So when you have both growth and inflation accelerating at the same time, we call that quad 2. When we have both growth and inflation decelerating at the same time, we call that quad 4. When you have, currently in the U.S. economy, we have inflation accelerating while real growth is decelerating. So we call that quad 3 or stagflation. So again, if you really want to boil it down, the economy is slowing when you're in quad 3 or quad 4. And when you're in quad 3, the dollar goes down. So there are a lot of different, we back tested every single thing in macro that you could possibly own, which would include Bitcoin. And, in quad 3, Bitcoin's going to do really well because the dollar is going to do really poorly. The U.S. economy on a real basis is doing quite poorly. So again, if you stay with the full cycle investing process, what you're really doing is you're just staying with these two very basic factors in macro as being causal. They're the ones causing the outcomes. And once those change, well, then you change your position. So, for example, if you were to go into quad 2, then all of a sudden you'd have real growth accelerating and people would find a lot of other things to buy. But when you're in quad 3, it's quite a damning situation economically where the people are really getting plugged with commodity inflation, things like that, higher cost of living. And I think that's why something like Bitcoin's going to continue to work higher and has most recently.
So I think one of the things that's really appealing to folks about this quad model is that it sets an analytical framework from within which we can have more precise debates, right? So policy has a dimension here where certainly you have expectations based on what we've seen in the past about what policy might do, but that becomes kind of an additional variable. And I think what people like I said, is that, it refines things down a little bit. And so one of the things that I thought was really interesting, I was going back and reviewing some of your writing and content from earlier in the year. And as we were coming into COVID, at the end of February, you guys said something to the effect of this. You wrote, risk accumulates much like grains of sand. Put more succinctly, risk happens slowly than all at once. Coronavirus is obviously a big risk to financial markets, but the overall instability of financial markets has been building for some time. So this was obviously something that you were seeing even before this crisis hit. So I guess, what were you watching earlier this year, kind of in the February timeframe? And then how has COVID changed or moved things since then?
Yeah, it started to manifest at the end of January and, to your point, into the heart of February, where it was kind of interesting because at that point, the S&P 500 was making all-time highs. There wasn't as much interest in the kinds of things that you'd be buying today. But it was just, like I say to myself all the time, it's just the data stupid. So at the end of the day, you can kind of be stupid about it because you just wait for the data to change. So what was happening was the economy was super late cycle. So again, just think about that, like back on the sine curve, coming off the very top of the sine curve. So the probability of an event was rising. So when you think about economies or nonlinear systems, anything in nature, when you think of it fractally, or how I measure and map it, again, not using linear assumptions or valuations or any of this old Wall Street, or as Portnoy would say, the suit's garbage in terms of like garbage in, garbage out. It was just very obvious that all of our predictive tracking algorithms real time were signaling a big deflation was coming. Now, deflation, again, is quad 4 in that GIP model that you mentioned. Again, it's a growth inflation policy model. And the P part of that model, which I meant to say, Nathaniel, you're basically front-running policymakers' actions. So if I know that growth and inflation are slowing at the same time at the end of February, at the end of January, obviously in March, everybody started to figure it out. Eventually, the Fed figures it out. And then the Fed, the P part of the GIP model, the policy response is to devalue the dollar, or it's to, again, print money. And then we had this, this glorious synchrony, I guess, in their own eyes from the establishment to effectively not only print money, but give away money, from the Treasury's perspective. So now you've got the rates of change in addition to the economy slowing, both growth and inflation slowing at the same time. You had the rates of change of the deficit rising, U.S. debt rising as a percentage of GDP. So it just became very obvious that there was a developing risk. Again, just like any sand pile theory, you're dropping grains of sand on top of a pile that's already destabilized. And once it was done, it was done. I mean, obviously the Fed's panic and the Treasury's too reflects the economic reality or economic depression that we had throughout March, April, and parts of May.
So basically, we have this sort of late cycle part. We're at quad 4. There's a huge exogenous event that happens. And so the next thing is the money printer revs up, right? I think that when we look back at early 2020, at least, the meme of the year will be the money printer go burn meme, like it or not. And so the outcome of this, or part of the expected outcome, and I think what we're trying to piece through now is inflation accelerating, right? And this is how we get into quad 3. But I guess one of the questions, and I see you debate this constantly on Twitter, is where are we expecting inflation to show up? It feels like this is maybe the most gotcha Twitter fight, FinTwit fight, since 2008 almost, about inflation or not and where it's going to appear.
I think that's because you have a lot of academic wonks or people that have their PhDs and are part of the establishment. They think on a linear basis. I affectionately call a lot of them linear econs. Or people that know nothing at all about economics that they just have an opinion on deflation versus inflation because they're long treasuries and a lot of different things that got them paid on the deflation side. We were there. I obviously understand it. But you can have a cyclical inflation within a longer term secular deflation. Inflation is pretty simple. It's in your account. I mean, it's in anything that you buy in dollars. If it goes up in price, that's inflation. I mean, if anything you buy in dollars goes down in price, that in your account is going to look like loss of money or loss of capital and deflation. So again, deflation is a much bigger risk. That's the big bang theory that a lot of people have, the end of the world thing. But the Fed is fighting against that. And their number one way to weaponize inflation without ever mentioning it. And the irony, obviously, Nathaniel, is that most government linear econs will say, oh, there's no inflation, not until we get to our target. By then, who knows what amount of money we would have made buying commodities and Bitcoins, anything that's got an intense inverse correlation to the dollar. In other words, as the dollar goes down at a faster rate, these assets inflate at a faster rate. I don't think it's a debate. I think it's actually probably the easiest debate that I get in plenty on Twitter, as you know, but I mean, this is an easy one. You can knock somebody out in the first round with this one.
Well, I think this is what's so interesting. And I do think that the kind of focus on wonky traditional measures, particularly the CPI, it's maybe also the area where I think regular people feel most disconnected from what policymakers are telling them, or at least one of the areas, right? And you pointed this out in terms of things like coffee prices. People have seen groceries go up, and these are measures that are excluded from CPI because of, they have a demand that's basically not going to change or fluctuate too much. But people, when they experience inflation, it's in those areas. And this is it's almost distracting to have such a focus from a kind of traditional academic economic perspective on this one measure of inflation.
Yeah, that is right on the screws correct. And again, just think back when the Fed or the establishment econs, when they're telling you that the risk to inflation, when's the last time they actually acknowledged that? Well, they said that at precisely the time that my model said we were about to have deflation, which was in Q4 of 2018. The Fed raised interest rates because they were concerned about inflationary pressures at precisely the peak of the sine curve on inflation. That's when headline or CPI inflation, the one that you called out, it was right around 2.8%. Some of the monthlies got to 3%. So well above their quote unquote target. Oh, so therefore now we're worried about it, right when you should be worried about a reversal. The thing about inflation is that it's mean reverting. It goes up, then it goes down. It goes up, then it goes down. It's actually one of the easiest things. Again, I've built predictive tracking algorithms to front run it. So I use a commodity, to your point, with like a lot of these different call outs, and human beings really do see, like if you're a carpenter, like my dad was, you're gonna have seen the cost of lumber has risen dramatically in the last month and a half. Or, to your point, if you drink coffee, you're gonna realize that. And that's the thing about the people. The people figure out systematically that things are inflating because they're paying the price of those things. Whereas investors, or people like me, have already front run them. That's the whole point. You got to get long inflation before the people at large realize it. And that by the time some government guy, central planning gal, by the time they tell us that inflation's here, the investment opportunity to have been long commodities or Bitcoin for that matter is way in the rearview mirror.
What's going on, guys? I'm excited to share that one of this month's breakdown sponsors is Crypto.com. Crypto.com offers one of the most cost-efficient ways to purchase crypto out there, as they've just waived the 3.5% credit card fee for all crypto purchases. What's more, with Crypto.com's MCO Visa card, you can get up to 10% back on things like food and grocery shopping. When you buy gift cards with the Crypto.com app, you can get up to 20% back. Download the Crypto.com app today and enjoy these offers until the end of September.
Bitstamp is the original global cryptocurrency exchange. Since 2011, Bitstamp has been the preferred exchange for serious traders and investors, trusted by over 4 million customers, including top financial institutions. Bitstamp is built on professional-grade trading technology. Their platform is powered by a NASDAQ matching engine, and their APIs are recognized as the best in the industry. Download the Bitstamp app from the App Store or Google Play, or visit bitstamp.net/pro to learn more and start trading today. That's bitstamp.net/pro. In this crisis, many investors aim to keep and grow their digital assets. Others seek to maximize the yield on their cash. Nexo allows you to achieve exactly these two goals. The company offers instant crypto credit lines against all major cryptocurrencies, with interest rates starting from only 5.9% APR. Nexo also lets you earn up to 10% annually on your fiat and digital assets. What's more, interest is paid out daily, and you can add or withdraw funds at any time. Get started at nexo.io.
Another part of this story that I think is really interesting is the dollar story. And I think we've seen kind of this narrative, two major narratives since the peak of the crisis, let's call it, in March around the dollar. The first was, holy crap, why is this thing staying so strong? There's all this money printing. We would expect it to get weaker. And then that weakening actually showing up, although there's kind of a debate a little bit, it feels like, around what the DXY story is actually telling us, right? Is this a dollar weakening? Is this just really a euro story? The dollar still seems strong against emerging market currencies. What do you make of the dollar narrative right now? And maybe more than the narrative, the actual kind of story of the dollar in a real way?
Well, I think generally, like, a lot of narratives are bullshit. I mean, there's a lot of people that have a narrative that fits their permanent position, if you will. And whether that permanent position be a political position on one side or the other of the aisle, or a marketing position of an asset class, people are just constantly spewing a narrative. Now, the thing with Wall Street is that their narrative is always moving. So what we call is that, there's narrative drift. The reality is that the dollar moves with deflation, like moves within the quads. The only time the dollar goes up is in quad 4. So again, that perpetuates deflationary pressures. That's why something like Bitcoin got smoked when you had deep quad 4 deflation into the thralls of March. And that surprised some people. It didn't surprise me. I mean, we weren't long Bitcoin at that point. We went bullish on it in April when it became very obvious that the Fed was willing to devalue the dollar and do it in a way that nobody, even beyond the wildest, I think the bulls, the people that love the Fed lovers, they call it, creative and innovative, ways. So at that point, it started to become clear that the dollar was done going up because the Fed was, and the fiscal side was committed to devaluing it. So by May, our signal and our model said that the dollar was done going up, starts to break down, and you finally get that dollar-based inflation. If you pull back a long-term time series of the dollar, we're just getting started. I mean, I think that's why you see such a parabolic move in the time. Like, I'm not just, bullish on Bitcoin. I'm bullish on a lot of things. And if it offends people that I call Bitcoin a commodity, that's fine. I mean, but I don't think of it as a currency. I think of it as a commodity that trades in dollars. So again, I think of silver the same way. People that think of silver as a currency, they might get offended. I'm not trying to offend people. It's just what my model calls these out as. And I call it a commodity because it has the volatility characteristics of commodity. So if you want to go through that, we can too. But what happens when the dollar starts to develop this intense inverse correlation to commodity prices? Currently, Nathaniel, it's 98% on a 30-day duration. Like the machine, the modern day machine in asset management, that's purely algorithmic, doesn't care about narratives, absolutely chomps on that all day long. So it just sells dollars and buys things inversely correlated to dollars. That 98% level on gold and on the CRB commodities index broadly that you have now is just unbelievably strong, almost unprecedented. Those are the things that I really care about. It's like, what does the math do? Not what is somebody telling me a story about. I can tell you a story about, Pump coming out and saying, look, I'm going to print another whatever and do this for whoever ahead of the election. I mean, I get the story, but the reality is if the dollar's not doing what it's doing, then I won't be as grossed up, if you will, on the invested side of long commodities and Bitcoin.
It's really interesting. I mean, I think one of the things that, I talk a lot about narratives here in this exploration, but it's always in the context of narratives being a battle of self-fulfilling prophecy, right? And the reason to understand narratives isn't to accept them, it's to understand what people are trying to tell you. And it's a weird combination of a lagging indicator or a sort of a lagging explanation as well as a leading indicator of people trying to push things and make them so. I think actually that's part of what makes Robinhood and the day trader phenomenon so interesting this year is that unlike a lot of folks who kind of have their perpetual narrative, these guys are willing to absolutely engage in total narrative warfare and use any means at their disposal to try to drive prices in a way that make their narratives, crude and memeified as they are, make sense.
Yeah, that is such a good point. I mean, for me, you may or may not, people may or may not believe this, but I can't even begin to comprehend somebody's narrative unless it's written in numbers. I just can't. There's no code for it. There's no backtest for it. There's nothing. So when I read things like at night, I read things in the morning, I'm literally reading rate of change numbers. It's not somebody's interpretation of the numbers. It's the rate of change, which is, again, some people kind of think this is funny, but when I say that or not, I mean, the secret to the universe is calculus. I mean, it's not that complicated. So if the rate of change of the numbers are moving, then I'm listening. I think narratives, human beings by nature, I think to your point, just need to tell themselves a story that they can believe in. But I go both ways all the time. I mean, I've been bearish on Bitcoin plenty of times and bullish on it now. I mean, I will go the direction of of the numbers. The rates of change, I'll change.
So I want to just add a little bit more to the US dollar conversation, because I think you had another tweet that summed this up nicely. You said being, quote, bearish on the US dollar since May of 2020 means being bullish on commodities, China, and emerging market equities. We talked a bunch about commodities, but I'd love those other pieces as well, if we could bring them into the story.
Yeah, I think that, I mean, again, a lot of people, their narrative is we as human beings have confirmation biases, recency biases. There's so many different heuristics that we have in our thick craws that people anchor on. But imagine for a second that you live in Mongolia or you live somewhere that's not, in the state of Connecticut, where I'm sitting today, which is a tough day for the state with the storm. But, people around the world for a long time have looked for an opportunity to see American weakness and to see American weakness through the lens of its currency. That's what all those other things are priced in. China's debt, for example, the largest swath of U.S. dollar-denominated debt in the world is held by the Chinese. If you take the dollar up, well, that's going to hurt them. If you take the dollar down, then that's going to be better for the Chinese. If you look at all of emerging market currencies, like you mentioned, and some people will say, oh, it's just against, like you mentioned, it's just against the euro. I mean, that's complete bullshit. The dollar last week alone was up against the Chilean peso like 2.5%. It's been up against that 8% in the last month. The Chilean peso, for God's sakes, the Hungarian forint is up almost 10% in the last month against the U.S. The bloodying of the U.S. dollar. So that's the thing, is that and think of it maybe like this. If you're a non-recency bias, non-confirmation bias, non-local human being, and you're sitting there and you say, okay, what currency do I want? If I work all day, do I want to be paid in a currency that's going to be worth more tomorrow or less? And how about like for now it's 7 straight weeks the dollar is down against their currencies. So you're damn right the Hungarian guy or the Chilean gal is happy because the currency that they're working their ass off for is going up in value. And so are their equity markets. Now, that's obviously there's a high correlation, inverse correlation between the dollar and emerging markets. So again, I often say this: if you want to get commodities, emerging markets, and China right, you got to get the dollar right. If you want to get the dollar right, you got to get the quads right. And that's why we start with the quads. Get that right first.
So there's another piece of this, and I think one of the things that, again, people appreciate about this type of analysis is that it connects the dots between otherwise disconnected data points or things that can feel disconnected. You had another tweet that said the bond market gets the quad 3 stagflation joke. What do you think that means? So
when somebody says, and this really is why you see, and I think it's a really good point that you make about the Twitter battle today. Just think of like how intense battles can be, but this one about inflation versus deflation. As soon as a traditionalist or an establishment person hears the word inflation, they think, okay, well, that means bond yields must go up. So you can't be long bonds. Again, that's bullshit, right? That is true when you're in quad 2, when you have the two factors in the model, real growth and inflation rising at the same time. So nominal bond yields are rising. Gold hates that. Gold collapses when you have rising real yields, and it loves it when you see real yields collapsing. So again, stagflation is when you take a falling growth rate, real growth rate. In this case, the U.S. growth rate's negative, so that's easy to understand. And then you subtract a positive and accelerating inflation rate. So all of a sudden, the negative real rate gets more and more negative. And that's what stagflation is. This is why, actually, if you go back to the 1970s, this even confounded Warren Buffett for a period of time in the 1970s, because he's like, holy shit, every time I buy one of these stocks, it goes, because he's a value guy, right? So he bought it at, let's say he bought it at 10 times earnings, and then it went to 9 times earnings. Then the S&P 500 went to 7 times earnings in the 1970s, because stagflation is so damning for P&Ls for a lot of different things. Just think of it. Your revenues are slowing, your costs are rising. That's it. So your margins are getting squeezed. Margin compression equals multiple compression. And that's why that happened. I think we're on the front end of that. And I think that's quite literally why now stock market up days are being led by commodity sectors of the market, not by, all the things that people would have traditionally expected, like banks or financials. Financials hate stagflation. So it's not just the bond market gets quad 3 stagflation today. Short sellers of financials get it. Financials are down 22% this year. The Nasdaq's up that same percentage or thereabouts. So I think the market actually, if you break it down into its parts, which I think a lot of people of the modern macro era would that aren't really, I call it macro tourism or narrative based, you can see it. All the different parts of the market understand this.
So the macro tourism thing is really interesting. And, one of the things that's interesting is that you've spent a lot of your career doing the actual number side of this, right? Making money by applying this analysis, by applying this process. But you've also made a major investment in media, right? In offering an alternative approach, an alternative take. How much is what you've called the old wall, the traditional financial media, at fault in kind of people's misunderstanding of what the markets are telling them?
Well, it's a blessing that they're still gainfully employed and running the place. So let's just start with that. I mean, there's so many components to this. We could have a whole discussion for 30 plus minutes on this topic. But I mean, there's a generational problem. All the establishment politically and from a Wall Street or the old Wall's perspective is run by a bunch of baby boomers. So again, it's not like my dog's name's Boomer. I'm fine with the name. I'm not trying to use it as a pejorative. The reality is that I'm Gen X, and most people I talk to are Boomers, Gen X, Gen Y, Millennials. It doesn't matter what generation the people I'm talking to about this are. It's the people are unanimously of one generation, of one establishment, of one view, the old Wall view, that are basically running the place. So the most recent example of that was when it came time to choose your liberty or safety. What did Wall Street and the old Wall choose? They chose to devalue the dollar, strap millennials with the largest deficit in the history of humanity, and debt too. That's what they chose. Some short-term safety at the expense of long-term liberty. And these are super long cycles. George Friedman just wrote a wonderful book about this called The Storm Before the Calm. And Friedman's got to be north of 70 years old, but he's a great geopolitical strategist. And we have one too, in Neil Howe, who I think you might know, he actually coined the term millennials, and he calls it the fourth turning. So these generational turnings, whether they be an institutional one that's like 80-year institutional turning, these are long cycles, or a 50-year one. Friedman, I think he calls that a socioeconomic one. There's a tremendous amount of angst and disbelief that starts to get built up into the end of a regime or a generation's reign. And that's what I think about that. I mean, Old Wall and CNBC has never been as conflicted and compromised as they've always been, whether it be banking fees, whether it be trading commissions, advertising dollars. And that's saying a lot, Nathaniel. I think people know that there's conflict of interest, but for it to be the worst it's ever been now, I mean, that's embarrassing.
It's interesting. So my first entrepreneurial project ever was actually a magazine about this generation, the millennials, called The Journal of a Generation That Doesn't Know Whether It's a Generation at All. And it was largely predicated on or influenced by a lot of Neil Howe's work, which is an interesting little twist. So this actually gets me, though, to maybe a kind of a wrap-up question that is something that I think is really fascinating. I'm interested in your take on your method, obviously, your process. You've built a process that helps you take advantage of, to make sense of, and then make money from the reality or the circumstance we find ourselves in. But you also get enormously frustrated by the decisions that are feeding into that system, right? And so I'd love your take, lastly, on kind of building out a little bit more on this question of income inequality, the Fed's role in it, and just the policymaker in general's, what they're doing to kind of straddle the next generation with just an untenable situation.
Yeah, it's the great moral divide in my thick skull. On the one hand, my number one goal is to preserve the capital that I've had the blessing to make over the course of the last 20 plus years working, and preserve that capital for my family and compound the returns on that capital. So that's on the one hand, that's my number one goal. And then on the other side, there's the moral decay associated with making money on something that is going to absolutely pulverize the people that not only I am still to this day. I mean, my father was a firefighter for 38 years. My mom didn't work. And I get it. I get that I'm making money on the back of a broken establishment's policy. And I just kind of I get frustrated with that. I'm sure you can see that, because it's frustrating to see that, as in particular, a great country like this. And I came here in the 1990s. I'm a Canadian. My family, my four kids are Americans. I came to this country. It wasn't like that. I mean, it was, free market capitalism was at a far more pure definition. And I get frustrated with that too, because I worry for my kids. I worry for what happens after all this, or what's about to happen now because of all this. It could start to happen tomorrow. It's already happening. I don't think that the gold price and the Bitcoin price in particular are validations that great central market plannings are working. I think that they're telling you that it's the beginning of the end of an establishment and a regime like the Federal Reserve.
What are signs that you take optimism from? Are there countervailing forces that you hang your hat on as you try to kind of wrestle with this challenge of where we're headed?
Yeah, conversations like this. I mean, it's kind of like therapy, a little bit. It's not about how many times I screw up. I make plenty of mistakes. Everybody can see those. I think it's about the opportunity, and really this is what I think generationally is the opportunity. It always has been in this country in particular. Generationally, people just throw up their hands and say, that's bullshit. And other conversations like this are happening, and it's okay I think I've said bullshit enough times that you could have called me out on it if you didn't think it wasn't. And evidently you haven't. So, I mean, and I have so many of these conversations. These conversations are real. These are the ones that I think the next generation should look forward to. Unfortunately, these have a central tendency to end in a mess before you can actually have new leadership, take control. But the establishment is locked and loaded. They're gonna play this out in full, and that's going to be one hell of a ride.
Well, along that ride, for people who want to strap on and keep track of what you are saying as opposed to what others are saying, and what Hedgeye is looking at, where can they find you?
Hedgeye.com. That's where most of the sound bites of what I'm trying to communicate, or my Twitter handle at Keith McCullough. I'm there every morning and then grinding away.
Awesome. All right, Keith. Well, thanks so much for hanging out today, and we'll see you on Twitter. One of the things that I really appreciate about Hedgeye and Keith is that their process is so rooted in a numerical analytical framework. We have such a strong competition for narrative in the social media sphere, in the mainstream media sphere, that to have a basis, a starting point that is so driven by just what the data is saying is really refreshing. I think, in fact, that in some ways, it gives Keith and Hedgeye an upper hand even when they're participating in a narrative conversation, because their whole point is that they're not wedded to one or another. One of the things that gets me the most excited about the future is that more than ever, a different demographic, a different set of people, a different generation is asking questions about the economy. And rather than just being accepting of the standard narratives that they're being told, they're wanting something different. They're wanting a deeper understanding, and they're wanting to go figure out what answers make sense to them. I think that's one of the major things driving interest in assets like Bitcoin. But it's not just Bitcoin. It's an entire new world of financial exploration that's opening up for a whole different group. And it's not just one age group. It's a lot of different people who have been excluded by traditional financial media. That's a powerful thing, because when more people and more different types of people have a chance to have their voice heard in the context of the economy, it breaks the power of those narrative gateholders that have shaped things for so long. Anyways, guys, that's it for today. I hope you enjoyed that conversation. We will be back tomorrow with another great interview. Until then, be safe and take care of each other. Peace.